Hello everyone, it's Shae Russell from Fat Tail Media. And joining me today from the other side of the world is none other than Rick Rule. Rick, how are you this morning?
Shae, better for being with you. Thank you for allowing me to talk to your audience.
No, thank you very much. You've always been a bit of a hit when I've featured you in our interviews with Australians. But today's interview comes with a purpose. Now, there is a very divisive US election playing out right now. Now, the Australian media is, let's just say, a little bit anti-Trump, and maybe perhaps they have a left-wing bias. I want to know, what's it like on the ground there for you in Vancouver while you're a little bit out of America? Obviously, you're still more connected to the American market than we are. So can you tell us from your point of view how you're seeing this election play out? And are the polls as wide apart as we're hearing down here?
Well, I should disclaim some of what you said. I'm an American citizen and an American voter. I should also disclaim any intention to vote for either Trump or Biden. I'm libertarian, so I'll vote for Joe Jorgensen, knowing that I'll do no harm. The election is fairly divisive. And in fact, the American media is broadly lined up against Trump too. I haven't really seen an election that's this divisive, maybe since Nixon's candidacy, which was a very, very, very long time ago. My own personal belief is, with regards to the election's impact on precious metals markets, it'll have absolutely no long-term impact. The political stance of both political parties calls for more quantitative easing, which is to say more counterfeiting. It calls for more debt and deficits. It calls for more taking from savers and giving to spenders, who are, of course, more numerous. And it calls for more negative interest rates. In other words, the Democrats, sadly, are great for precious metals. And the Republicans, sadly, are great for precious metals. The two candidates, I call them Tweedledum and Tweedledummer, in neither particular order, I think are bad for America. H.L. Mencken, a famous American journalist, once said that the voters almost always get what they want, usually good and hard. And I think that that will be the case in this circumstance. I do believe that a Biden election accompanied by Democratic control of Congress would scare the hell out of mainstream financial markets. The idea of a wealth tax and the idea of greater corporate profits tax, I think would be very difficult on broad equities markets in the near term. But I don't see anything in the next 3 or 4 years that will cause the Fed or the government to stop spending other people's money, in particular your generation's money. And fortunately, I guess for me, unfortunately, that's very good for precious metals and very, very good for precious metals equities.
All right, before we talk about precious metals equities, because I know you have something incredibly generous you would like to talk to the Australian audience about, let's just sidetrack a smidge. And I know I've got a few questions to get through. How do we get my generation interested in precious metals as governments continue to spend our money and basically give us a debt that might be unpayable?
You know, Shae, I'm embarrassed to talk about this. I remember visiting with you on a boat cruise in Vancouver where I plied you with wine to get you to answer questions, talking about your success at reaching Gen X and Gen Y. And being 67 years old, I didn't know how to do it. What I did was I made myself reasonably ubiquitously available on social media, and they found me. I've had thousands of conversations with young investors. And the easiest way to get young investors' attention is not to talk about economics in a broad sense, but rather in a personal sense. The fiscal policies that you see in the United States, and for that matter in Australia and New Zealand, are pretty simple. Elections are everywhere around the world really best characterized as advanced auctions of stolen property. That's what they're about. You elect a politician to protect you from your neighbor while he steals from your neighbor on your behalf. Now, what really happens in fiscal policy is that the spenders, who are very numerous, attempt to steal from the savers, who are somewhat less numerous. In Australian parlance, an election is 4 dingoes and a lamb voting on the lunch menu. The dingoes, of course, being the spenders. And in terms of introducing your people to the context, you need to understand what debt and deficits are. Deficits are all of the benefits that old people have voted themselves. And debts are you paying for all of it. So when you explain the political process as a transfer of wealth from relatively unwealthy young people to relatively wealthy old people, well, from my point of view, this is somewhat amusing. When younger people come to understand that stark reality, they suddenly become interested in my message. Irrespective of my, lack of hair and all that kind of stuff. So suddenly I've become an economic guru among young people because I'm the first one who appears to have told young people the truth in relatively simple English.
And I hope they thank you for that, and I hope they continue to reach out for you to get your insights. Now, obviously, as you've just pointed out so clearly, that either candidate is not going to interrupt the precious metals train right now. But let's talk about broader commodities. I mean, how do you see this particular US election having any impact, I should say, on particular sectors of the commodity market? Is it good for uranium? Is it good for battery metals? There's dirty coal that keeps raising its head every now and then.
I don't see this election being good for commodities at all. I personally believe, mercifully, I've been wrong for 6 months. I personally believe that the global economy is going to weaken. I believe that because we've had a 10-year recovery since the 2008 collapse. And that recovery wasn't fashioned by greater productivity or increased trade or increased wealth. It was fashioned by artificial stimulus. I'm not an economist, but I've been investing for 45 years. And in my 45 years, a 10-year expansion was always followed by a recession. The big thinkers of the world, be they your parliament or our Senate, seem to believe that they can outlaw recessions. But my suspicion is that the markets will be bigger than the politicians. The other thing I believe is that the dichotomy between equities markets and the economies that we're seeing in the private sector, that is Main Street, is very broad. And I don't think that financial markets have factored in the damage done by the global economy, by the COVID-19 virus. I think this happens because of excess liquidity and artificially low interest rates. And I suspect, like any really good party, Shae, that this is going to be followed by a bit of a hangover. So my suspicion is that we're going to see 3 or so years of relatively weak global economic performance, which should mean that we have 3 or 4 years of relatively weak commodity prices. As I say, in the context of iron ore and copper, mercifully, I've been wrong so far, although I'm afraid I'm going to be right. But the Australian market will love this. If we have 3 more years of underinvestment in industrial materials, say iron capacity, nickel capacity, oil and gas capacity, uranium capacity, what happens when you balance supply and demand by reducing supply is that you set the stage up for a, pardon my rude American colloquialism, but rip your face off rally. The type of rally that we saw in 1999, 2000, 2001. When you balance supply and demand by reducing supply, the industry can't increase supply to meet the pricing signals. For those of your listeners who are too young to know what I'm referring to, the decade of the 80s and the 90s was tough in resources, tough in rural Australia. By the time that the bull market came around, everybody had written commodities off. The copper price in US dollars was 75 cents, went to 450. The natural gas price was $1, went to 15 bucks. I'm talking US dollars. The oil price was 15 US dollars, went to 130. The truth is that when you underinvest in sustaining capital and project capital, the ultimate result of that is that the commodity prices soar way above the incentive price to some other price level. And I'm delighted to say that, frankly, I close out my career the next 6 or 7 years with a bull market in precious metals, followed by a bull market in industrial materials. I couldn't have scripted it this well.
Well, okay, well, let's bring that back to how this relates to Australia. You know, we're a commodity nation. Basically, we either dig it up or build it up. It's pretty much all we've got to offer the rest of the world. We're not doing a whole lot of building up at the moment, but all we've really got to offer the rest of the world is commodities, what's underground. But if we're looking at weak commodity prices going forward, what does that mean for Australians and Australian investors in the stock market?
Well, a couple things. The first thing is that mercifully, in terms of things like coal and iron ore, you're a low-cost producer. There's an ugly, sexist phrase in the mining business called the last man standing, which means that you are able to produce through downturns better than your rivals. And so while the downturn hurts Australia, it murders the high-cost producer. It absolutely murders the high-cost producer. The truth is there's no iron region in the world, including Brazil, that can compete with the Pilbara. The Australian coal fields, although I know Greta doesn't like coal, the Australian coal fields are extraordinarily low-cost producers. My own belief is that at some point in time, Australia might deign to acknowledge their importance in the uranium business as opposed to being ashamed of it. Maybe I'm asking too much. I don't know.
We're trying.
I mean, the truth is that the next 3 years will be substantially less generous than the period, say, 2004 to 2008 was. But, you know, that was maybe the most benign period in Australian history. But now, I don't want to make any comment on Australian politics. My belief is that politicians around the world have an uncanny knack of stealing defeat from the jaws of victory. But my own belief now is that at least WA is probably the best regional jurisdiction in the world to be in the mining business. Australian sins notwithstanding. I regard WA politically like I regard the US dollar economically, which is, to quote Doug Casey, the prettiest mare at the slaughterhouse, you know, ending by fake praise. And I think that'll attract a lot of attention. Australia also doesn't give itself enough credit, I think, for the human resources that you have in the mining business. Australia is a mining country, all the way from the truck driver and the jackleg operator to the geologist and the financial executive. There's a tremendous human endowment in Australia that gives you, I would say, a durable competitive advantage, not only in Australia, but also in terms of exporting your technology and financial prowess. At the risk of sounding too flattering and patronizing to your audience, I suspect that even the Australian politicians will be incapable of squandering the fortune which is coming your way.
I think you might be giving our politicians too much credit, actually. All right, finally moving on. I wanted to close out today with, you know, precious metals. This is your wheelhouse. This is also my wheelhouse. Australia has some, I believe, incredible mining opportunities. We've got great explorers. We've got a great mid-tier sector, and we're starting to create genuine international precious metal giants with the form of Newcrest, and there's a recent merger that's happened here. Do you have a particular view on Australian precious metal mining stocks?
I do. They outperformed globally for 3 of the last 5 years, and they have underperformed more recently. And my suspicion is that they'll begin to outperform again for a variety of reasons, particularly the Australian producers, where the majority of their production is in Australia, benefit, ironically, from a fairly weak Australian currency. If your input costs are denominated in a currency which is sinking relative to the currency that your prices are denominated in, you have an immediate advantage. The second advantage, I think, is enjoyed by all producers, but particularly Australian producers, in that energy prices are extremely low. And energy is an important input in the mining business. But importantly, too, yours is a mining culture. And my suspicion is that all levels of Australian society will reach some form of political accommodation around mining before other societies will. Which I think is very important. The rationalization that you're beginning to see in Australia, the most recent merger, Northern Star and Saracen just being the most recent example, is extremely, extremely logical. Synergy is an overblown word, but lowering general and administrative expense relative to assets under management or relative to EBIT is the easiest way to grow free cash flow. It simply is. If you fashion $100 million a year in administrative cost savings, that's like a mid-sized gold mine that never depletes, or at least it doesn't need to deplete. And my suspicion is that you're going to see consolidation through the length and breadth of the Australian industry. And while maybe the managers who get laid off think that's a bad thing, from the investor's point of view and the equity market's point of view, this is a wholly, wholly good thing. It's important to remember in precious metals that the wind is truly in precious metal sales. On a global basis, we are seeing at least 5 factors that are good for gold. In Australia, 6. And let's go through them just to get people's mind focused. Quantitative easing. That's debasing the currency. If Shae did it, it would be called counterfeiting, and your pretty face would be in prison. If it's done at the government level, it's policy and it gets you elected, but it still debases the currency. Debt and deficits debase the currency too. They're happening in every country around the world, including the allegedly strong ones like the United States. Artificially low interest rates are the best stimulus for the gold price. If you know for sure that your savings are being depleted in savings instruments, you look to protect yourself in fashions other than things like the US 10-year Treasury. Artificially low interest rates are always good for the gold price, and I think they're with us until the market rebels, until there's a bond auction where there's a strike of bond buyers. Then there's the fact that, not so much in Australia, but in the United States, precious metals and precious metals equities are under-owned. The market share of precious metals and precious metals related investments in the United States is 0.5% of total savings and investment assets in the United States. The 3-decade mean is between 1.5% and 2%. So if it just reverts to mean, demand for precious metals related investments in the United States triples or quadruples. And finally, and you will see this in Australia, about $100 trillion in assets worldwide are managed institutionally. And the institutional mantra has always been 60% equities, 40% debt. The theory being, if loan demand was strong and interest rates went up, the share market would go up faster. If the economy was weak and loan demand fell, then interest rates would fall, and so the bonds would pick up for the fact that the stocks were slack. But in negative interest rate environment, the institutions can't afford to have a 40% negative carry in the bond market. And negative interest rates means that there will be forced disintermediation from debt instruments into other forms of instruments. I'm not saying that the gold market is going to get the whole $40 trillion. That's not going to happen. I think it's going to get 2 or 3 or 4%. And 2 or 3 or 4% of $40 trillion over 4 years is an awful lot of money. And then once again, in Australia, you have this virtuous benefit of having the resources in place, having the human resources in place, and the dubious benefit of having a falling currency, which lowers your input costs. So I suspect it's going to be better than many people in Australia think. Perhaps the seventh benefit is that the rest of the world is beginning to understand the resource sector in Australia. By the rest of the world, I don't mean Great Britain, which has perhaps known about it for 50 or 60 years, but places like the United States, where we had a very difficult time spelling antipodes, or Australia or New Zealand. The internationalization of the demand for Australian natural resource equities, I think, will really surprise the Australian issuer community and the Australian financial services community.
I have actually said repeatedly, to our detriment, almost nobody in the North American markets have heard of some of Australia's greatest companies. They could tell you of the Fosterville mine, only because that's owned by Kirkland, and that giant hole out in the ground. That's pretty much all, unless you're in the business. Even then, when you're in the business, very few people like yourself have a specialist knowledge of the Australian market. Now,
you know, I've been too nice to you in this interview, Shae. You know, Fosterville proves that the Australians need to buy a rig in the eastern goldfields that goes below 300 meters. The fact is that you guys were so busy drinking beer at Bendigo and stuff like that you never bothered to drill into those old workings. It took the Canadians to come and find that gold for you.
Yes, it does, and it's one of my favorite stories to tell to Canadians. Now, you have been incredible with your time today. I love talking to you as always, Rick. But you're about to make an offer to my subscribers and fellow Australians watching, which as an analyst does strike a little bit of fear into my heart, but I do love a little bit of criticism as well. So could you please tell everybody what you would like to do and how they can get in touch with you?
Absolutely. There's a website, SprottUSA.com, SPROTTUSA, all one word, .com/rankings. If you go there, you'll find a web form. And if you enter on that web form the name and symbols of your natural resource holdings, please no banks, please no technology companies, please no pot companies, I will rank those companies 1 to 10, 1 being worst, 10 being, 1 being best, 10 being worst. And I'll comment on those individual issues where I think my comments might have some value. In addition to that, I will send your listeners a 50-year copy of the Barron's Gold Mining Index, which is the broadest based, longest running gold equities index in the world. I'm not a technical analyst, but it's a wonderful visual tool to see where we are in this gold bull market relative to historic bull markets. It's just an incredible tool. It's also a wonderful tool for visualizing the volatility of these markets and preparing yourself psychologically for the ups and downs. In addition to that, I'll send a 100-year commodity chart that looks at commodities valuations relative to other asset classes, again, as a visual tool, looking at the cyclicality and volatility of commodities markets, but also the absolute valuation relative to historic norms. These are wonderful visual charts. And as I say, there's no way that I can think of that's better to impart mining stock education to people than to personalize it, make it about their own portfolios.
Rick, I just want to say I think that's an incredible offer. And also, too, I just want to reinforce this. No banks, no tech stocks, no telcos, nothing like that. Let's stick to what you're great at, and that's commodities and precious metals. So precious metal stocks and commodity stocks, everybody make sure you get them into Rick. And as I said, I know there's a lot of people listening who have bought my recommendation. So obviously, if you are holding them, make sure you let Rick know. All right, Rick, unfortunately, we will have to leave it there. It's been an incredible chat with you, as always. And I thank you for your time, and I look forward to speaking with you again.
Let's do it again, Shae, and let's see you back up in Vancouver, or if they ever let me out of the United States, I'll come see you down there.
I would love that, Rick. I owe you a beer at the very least.
Thank you, ma'am.
Thank you.